Hello, everyone. Welcome to the NT Trading. Indian stock markets have been under pressure as they continue to face headwinds from weak corporate earnings and persistent foreign portfolio investor (FPI) outflows. The benchmark indices extended their losses, with the BSE Sensex falling by 138.74 points, or 0.17%, to close at 80,081.98. While the Nifty 50 slipped 36.60 points, or 0.15%, ending at 24,435.50. This marks the third consecutive session of losses, underscoring the challenges facing the market. Despite a promising start, where IT stocks lifted both indices early in the trading session, financial stocks eventually dragged them into negative territory. While shares of non-bank lender Bajaj Finance provided some support, it was not enough to offset the overall market weakness. Weak earnings reports from several major corporations have dampened investor sentiment, causing early gains to evaporate as the session progressed. One of the primary concerns continues to be the sustained foreign selling that has plagued the Indian market in recent weeks. Foreign investors have been net sellers for the 17th straight day, and this persistent outflow of funds has created a significant drag on the market's performance. In fact, the Nifty index has shed approximately 7% since reaching its all-time high on September 27th. The record-setting level of foreign selling is set to hit new highs, further eroding confidence in the domestic equity market. Adding to the market's woes, Goldman Sachs has downgraded Indian equities from overweight to neutral. The downgrade is largely based on concerns over slowing economic growth, which is expected to weigh heavily on corporate earnings. With corporate earnings for the September-ending quarter already appearing muted, the outlook for the near future remains bleak. These fluctuations are expected to persist until there is a meaningful slowdown in foreign outflows or a marked improvement in earnings reports from Indian companies. Several factors are currently contributing to the pressure on the Indian stock market. Valuations remain high, making the market less attractive to global investors, especially as earnings growth has been sluggish. The geopolitical tensions in the Middle East are adding an additional layer of uncertainty, while the upcoming U.S. elections create further unease for investors. These factors, coupled with expensive valuations and tepid earnings, have made Indian equities less appealing to foreign portfolio investors who are now redirecting their capital to other markets. Another significant factor influencing market sentiment is the recent movement in U.S. bond yields. The U.S. 10-year yield has been inching higher, signaling a slower pace of rate cuts by the Federal Reserve. This has led to a risk-off sentiment toward emerging markets like India, as higher bond yields in the U.S. make equities in those markets more attractive by comparison. As long as U.S. bond yields continue to rise, there will be downward pressure on Indian stocks, particularly in sectors with high valuations and subdued earnings growth. Among the sectors, the Nifty IT index provided a glimmer of hope, rising by 2.38% and ending a three-day losing streak. The recovery in IT stocks highlights the potential resilience of the sector, even as other industries struggle with weak earnings and foreign outflows. However, despite this recovery, the broader market remains in a fragile state. Looking ahead, the fluctuations in Indian equity markets are likely to persist in the short term. Until there is a meaningful reduction in foreign selling and a significant improvement in quarterly earnings, the market will remain under pressure. Investors should remain cautious as geopolitical tensions, rising U.S. bond yields, and the uncertainty surrounding the U.S. elections continue to weigh on sentiment. In conclusion, while Indian markets are facing a challenging period, there are still opportunities for growth and recovery. The IT sector's recent performance offers a glimpse of resilience, and as corporate earnings season progresses, there may be brighter spots on the horizon. For now, however, it is crucial for investors to remain vigilant and closely monitor the global and domestic factors that are shaping the market's direction. This video is made for educational purposes only. Please don't make any investment decisions based on it. If you like the video, please like, share, and subscribe. Thank you.